You probably hold 0 bonds in your investment portfolio, while the wealthiest families hold up to a quarter in bonds and cash equivalents. So why is that? I'm Andrew, the founder of 8 Figures, and I see this all the time. Retail investors keep ignoring bonds as an asset class. Today, we're going to dive into bonds, and you will see how this asset class can benefit your investment portfolio. Let's go. So look at the two numbers on your screen. On the left, a 0. That's how many bonds you probably own on purpose. On the right, about a quarter. That's how much the world's wealthiest families keep in bonds and cash. Now, these aren't cautious retirees playing it safe. These are family offices, the private firms that manage the fortunes of the ultra-rich, and they choose that quarter deliberately. So one of you is wrong. Either the best paid investors alive are making a mistake with a quarter of their money, or you're the one missing something. I'll tell you right now, it's not them. Here's what they see that you don't. Now start with the strangest fact in this whole story. Warren Buffett tells the public to buy stocks and hold them. But his own company, Berkshire, is holding more money in short-term loans to the US government than in its entire stock portfolio. Those loans are called Treasury bills. T-bills for short. Look at the two bars. Berkshire is sitting on about $339 billion in bills versus $288 billion in stocks. More in bills than in the whole stock book. And here's the thing, nobody forces him to. Pensions have to hold bonds to match the checks they owe retirees. Buffett doesn't, he just chooses to. Meanwhile, look at the call-out. Only about 1 in 90 US families owns a single bond directly. 1 in 90. So the gap was never about access. You can buy the exact same bills Buffett does. It's about knowing why. So why do they? So here's the reason. Getting rich and staying rich are two different games, and the wealthy play the second one. Now, one investor on Reddit summed up the other side. Bonds are for old people, he said. Young people should just ride the wave. The math on your screen is what that misses. Lose 50% and you don't need 50% back. You need 100% just to get back to even. 50 down, 100 to climb back. A deep hole is far harder to climb out of than to fall into. That's what bonds are for. They're the sleeve of your portfolio you can spend from and rebalance from, so you're never forced to sell your stocks at the bottom. And honestly, this matters more for you, not less. A wealthy family can wait out a crash. But if you lose your job in the same recession that tanks your portfolio, you can't wait. You sell low and you lock in the loss. That's the risk bonds insure against. So what are these things really? Now let me kill the myth that keeps most people away from bonds. The myth says bonds are one boring thing. Look at the ramp on the left. It runs from T-bills at the safe end all the way out to distressed debt at the risky end. Distressed means debt from borrowers in trouble bought cheap, and it can pay back several times what you put in. Same word, completely different things. And it's not some niche corner of finance either. Look at the two bars on the right. The global bond market is about $145 trillion. The entire global stock market is about $127 trillion. The bigger market is the boring one. So when you skip bonds entirely, you're not skipping one boring thing. You're ignoring the largest toolkit in finance. Next, the myth that bonds pay too little to bother with. So here's the second myth. Bonds pay too little, the story goes. So why bother? Just hold stocks. Or just hold cash. Both miss the job. Look at the card on your screen. A bond's job is the floor, not the ceiling. Predictability is the feature. It's what lets you take risk on top without ending at zero. Now, just holding cash is the trap that feels smart today. One investor put it exactly this way. You'd be way better off having cash. Just sit in a money market fund. Sounds reasonable. Here's what it misses. Cash pays you something right now. Over time, though, it quietly loses to inflation. And unlike bonds, it doesn't rise when stocks crash, which is exactly the moment you need something that does. So for you, the question was never whether bonds beat stocks. They don't, And they're not supposed to. The real question is what keeps you invested when everything is falling? So how do we know the floor actually matters? 2022. Now 2022 is the stress test you don't have to imagine. You lived it. The S&P 500 fell about 18%, Bitcoin fell over 60. A portfolio of only stocks and crypto had nothing to cushion the fall. And here's the twist most people miss. Bonds fell too. The broad bond market dropped about 13%. That's why you kept hearing that bonds are dead. But look at the two ends of the chart. Short-term treasuries, the T-bills we just covered, actually went up about 2%. Long treasuries fell about 31%. Same asset class, opposite results. The reason is in the call-out. Rates went from near zero to about 4% in a single year, the fastest jump in 40 years. Long bonds get hit hardest when that happens. Short bills barely move. So the lesson isn't avoid bonds. The lesson is that the safe part of the floor is the short end, which raises the obvious question. Was 2022 normal? So look at this line. It's the broad bond market. Year by year, and 2022 just jumps off the page. One deep plunge in an otherwise calm line. Now, look at the other down years. They barely dip below the zero line. Most down years barely register. Then there's 2022. It fell about 13%. That's its worst year since the index began back in 1976. Down 13%, and nothing else on the chart comes close. So 2022 was the rare exception, not the new normal. Now, there is a real nuance here, and I won't skip it. Stocks and bonds usually move in opposite directions. But in 2022's inflation shock, they fell together. That's the one environment where bonds protect you less. So the takeaway isn't that bonds always save you. They usually do, when stocks crash for the usual reason, a recession. And you manage the exception by keeping part of your safety in short bills and cash. Now let's name all 6 kinds. So the map on your screen sorts every bond by the same 2 dials. In plain English, 2 kinds of risk. Across the bottom, default risk, the chance you're not paid back. Up the side, rate risk. How much the price drops when rates rise. Turn those 2 settings and you get all 6 kinds. Down in the safe corner, T-bills for parking cash safely. Up top, long treasuries. That's the ballast, the part that rallies when stocks crash. Then other government bonds, spreading your bets across countries. Now move right, and you're taking on default risk to get paid more. Investment-grade corporates, meaning top-rated company bonds, pay steady income above treasuries. High yield, the market calls it junk, pays more and acts like stocks. And distressed, out at the far right, is buying troubled bonds cheap, hoping for a rebound. A pro's game, not a starter move. So you don't need all 6. You just need to know which dial you're turning, which risk you're signing up for. Here's where you start. So here's the first move, and it's mechanical, not a judgment call. If you've got cash sitting in a checking account earning basically nothing, the starter step isn't a hot stock. It's a simple ladder of short-term treasury bills. Look at the 3 rungs, a 4-week bill, a 13-week, a 26-week, then you just roll each one over as it matures. That's the whole ladder. And there are 2 quiet edges here. Treasury bill interest usually outearns an ordinary savings account, and it skips state and local tax, which in a place like California or New York is real money on every dollar of interest. So for you, this is the lowest risk win available. Your idle cash starts earning. Your money isn't locked away and you're not making a market bet. Once the safe end is handled, do the thing almost nobody does. Look at what you already own. So the second move costs nothing and it changes everything. Get visibility. Step 1, pull every account into one view. Brokerage, retirement, that old 401k, cash, all of it one screen. Step 2, sort what you own by the job each piece does, not by ticker. Growth, safety, income, or ballast. Step 3, ask the hard question of every line. What is this actually here to do?
And most people can't answer that for their bonds. Their only bond exposure is buried inside target date funds, the set and forget retirement funds they stopped reading years ago. So if you can't name the job a holding does, that's the diagnosis, not a verdict. It's fixable. And honestly, that's the exact discipline a family office runs on. It's the real reason they don't blow up. But before you go all in, you deserve the honest counter argument. Now, here's the strongest case against everything I just told you. Because if I skipped it, you shouldn't trust the rest. There's a major study from 2025 by finance professor Scott Sederberg and his colleagues. They looked at 38 countries. The data runs back 130 years, and it found that an all-stock portfolio beat the stock and bond mixes. Not just on growth, on avoiding ruin too. Bond-heavy target date savers would have needed about 63% more savings just to end up in the same place. But here's the catch, and the authors admitted themselves. It only holds for someone who never breaks, someone who never panic sells through a crash that cuts their portfolio in half, and who is never forced to sell. Almost nobody is that person. So bonds cost you something. They're the price of being human, and of maybe needing your money early. If you're truly the person who never breaks, hold fewer. Everyone else, that floor is doing a job. Let me pull it together. So here's what to take away. The wealthy don't hold bonds because they're dull and cautious. They hold them to protect what they've built and to keep dry powder, cash that's ready to act for when everyone else is panicking. Second, bonds aren't one boring thing. They're a spectrum. From cash-like bills all the way to distressed debt, and each kind does a specific job. And third, the first moves are simple. Put your idle cash to work at the safe end. Then get honest visibility on what job every dollar you own is doing. So the real question was never, are bonds boring? It's, what job is each dollar doing? Answer that, and you're already managing your money the way the wealthy do.
So you gotta get to know bonds if you wanna start building your wealth for real, like professional investors and wealthy families do. If that was any helpful, please subscribe so you don't miss the next video. And by the way, do you actually hold bonds in your portfolio? If you do, leave a comment below. What exactly bonds do you hold and why? See you in the next video.